A very good morning to all of you students. My name is CA Divas Gupta and today we will be discussing on the topic of derivatives. So let's first start about the basic concepts on derivatives. Then we will also do some of the questions to make our understanding better. Good morning everyone. So to understand derivatives, students, we first need to understand that if I say that there are two different kinds of products, okay? By product, I mean that, for example, A is a financial instrument. So by financial instrument, I mean any type of a financial contract which is required to be settled in cash or cash equivalents. Okay. So that is broadly a financial instrument. So if I say that A is a financial instrument, when it will be called as a derivative? If this financial instrument derives its value from another instrument that is called as B, which we call as underlying. We call this as underlying because this is the real basis for the prices to be derived by the financial instrument, which is A. So now to connect them, if A value is dependent on B, or if A derives its value from B, either of the two, then this A part, this financial instrument is called as a derivative. So, or A derives its value from B. So, students, as the name suggests, the derivative is not having its own value, right, or its own price. It always derives its value or price from the underlying. Okay. Now, if I may say, what are the different types of underlying? Right? What are the different types of underlying basis which the value can be derived? Can anyone or do anyone want to attempt this? What do you think can be an underlying for a derivative to derive a value?
Gold,
Yes, gold. Can I say a more refined version of gold as commodity? Right? Because commodity will include all your gold, silver, metals, even let's say sugar, pulses, everything will get included in commodity, right? Stocks, yes, which I can say as equity, right? Apart from this, anything else that you can think of? Can I also say, yeah, environment to some extent, yes. Can I also say about the foreign exchange? For example, dollar rate, for example, GBP rate, right? So foreign exchange is one of them, commodity, equity. Then another kind of underlying can be index, any sort of index. For example, BSE index or NSE index, right? NSE is Nifty, BSE is Sensex. So on that also, that can also act as an underlying for something to derive its value. We are just first trying to understand that what are the bases of these underlyings, right? Now, for example, there is a commodity, or let's say there is a equity of X Limited. Okay. Now, on this equity of X Limited, there will be different kind of financial instruments that will be deriving its value that we will cover in detail in the subsequent part, right? So those financial instruments are called as derivatives, which derive its value from the underlying. And let me tell you, A and B, this A and this B are totally two different, separate financial products, I would say. Okay. Now, it is also mentioned about environment, right? So, can I say that weather, what is the humidity, what is the wind speed, temperature, right? All these are specific measurable inputs that can act as a underlying. Okay. So, and this list can continue, right? This list is not only these five, this can continue. Anything which where price is not certain can act as an underlying, right? And there is a derivative, there can be a derivative which can run on that underlying. Okay. I think clear till now. Should we move ahead? Now, let's try to understand some of the basic features of derivatives. Now, what are some of the basic, or I would say common features, right? Because these features are common across all types of derivatives. One, there is a buyer and seller. Of what? Buyer and seller of A, this financial instrument. Okay. See, definitely there is a buyer and seller of this underlying. Okay. That's a separate story. But we are talking about that even the derivative will have a buyer or seller which is very much different from the buyer or seller of underlying. So, what we are talking about, that buyer and seller, buyer will buy A. Why I'm specifying A here? Because A is the contract, right? A is the financial instrument that we have spoken about. And seller will sell A to the buyer, right? I'm trying to draw a distinction between these buyer and seller from the underlying. Okay. And these buyer and seller are separate from the buyer and seller of the underlying. Now let us take an example that we are talking about the equity as an underlying. Okay. Which is B, and A as a derivative. Okay. Now for this A derivative, let's say Mr. A is the buyer and Miss B is the seller. Okay. Similarly for equity underlying B, let's say equity by equity, I mean sale purchase of the shares in the share market, right? That's what I'm referring to equity. So for that equity, there can be a different buyer or seller, the actual equity I'm talking about. Let's say Mr. C becomes the buyer and Miss D becomes the seller. And the sale purchase of this equity, which is this underlying, can happen at a different frequency, can happen at a different timing, can happen at a different volume, right? Compared to the sale and purchase of this derivative. Okay. Only price is dependent, not other things. Okay. Even if let's say equity is not being traded in the market, still derivative can trade on the market. I hope this is clear. So students, please note that these are the building blocks of our discussion, which are very useful in the next part of the session. So in case there are any concerns, please do ask. So generally for these derivatives, practically we call this as a FNO market, futures and options. Okay, we will what are these futures and options, but this is a segment of the market called as FNO market. And this is called as the cash or spot market. Why cash or spot market? Because you go pay for the shares and purchase it at a gross level, right? Here generally derivatives are only traded, and here the equity itself is traded. I'm just focusing only on equity as an underlying as of now, right? Then we will also explore towards the later part of the sessions about the other derivatives. But as of now, we will keep on focusing on equity itself. Okay. So, so this understanding is clear. Now, this is the first basic feature of the derivatives, right? If you talk about futures, there is a buyer and seller. If you talk about forwards, there is a buyer and seller. If you talk about options, there is a buyer and seller. So every derivative will have a buyer or seller, which is common across all the different types of financial instruments. Now Karthik is asking, sir, can mutual fund be said as a derivative? Mutual funds are different category. They are not derivatives, although their NAV depends on their underlying, right? Wherever the amount has been invested. But generally, mutual funds are not classified as derivatives, right? Because someone would want to enter or exit, they can do at the today's valuation as well. Okay. So the second part, or the second common feature, basic feature of derivative is the value of derivative is dependent on the value of the underlying. That is what we already have understood. Value of a derivative is dependent upon value of the underlying. So we will understand in detail how this value is derived, what are the formulas for different types of instruments. Okay. So till that time, I would say that you only understand that the derivative derives its value from the underlying. Okay. Then third, there is a fixed tenure of the instrument. Fixed tenure of A, which is derivative we were talking about, right? So this has a fixed tenure. Let's say 1 month, 2 months. So this financial instrument, as I said that A is what? A is a financial instrument. So this A is a financial instrument. By financial instrument, I also explain it's a financial contract. So contract always has a fixed tenure, right? Whether 1 month, whether 2 month, 3 month, or let's say in case of any type of year also. It can be let's say for 1 year, 2 year, 3 year. The tenure has to be there. Now, why are we saying that tenure is there? Because using the tenure, the settlement will happen eventually. Okay, we will understand how settlement will happen, how payoffs will be calculated. All those are part of the discussions. So now Abrikesh is asking how far is it different from India's 109 definition, derivatives or same? Now I would refrain from saying anything on the Indies, right? At least from a definition perspective, what we understand in our curriculum is derivatives are something that derive its value from the underlying. Okay. While you will go through the Index 109, you can understand about the derivatives definition there. Okay. Yeah. Settlement. The fourth basic feature of the derivatives is about settlement. That ultimately it has to be settled, right? Some of the, let's say today I enter into a derivative contract for a period of 3 months, right? So December, January, February. February becomes the due date, right? 3rd of February becomes the due date. Now, This 3rd of February 2025, it has to be settled. Now, how it will be settled? Either buyer has to pay something or seller has to pay something, right? How much has to be paid, how that will be calculated, we will cover that. But there are certain settlement related payoffs from buyer to seller, or even it can be from seller to buyer, right? So ultimately, whenever there is a settlement, ultimately I'm saying that all the derivatives will have a settlement because they have a fixed tenure, they also will have a settlement in place. Okay. Now, what are the four features? Again, I'm just going back. One, there is a separate buyer and seller from the original instrument, which is an underlying. The value of this derivative is dependent on the value of the underlying. There is a fixed tenure of that particular derivative. And finally, after the fixed tenure, settlement has to happen. Okay. And this is true across any type of derivative. Clear, students? Now, if I may say that all the features I can plot into two buckets. One is there are certain things which are actually fixed. I'm saying either they are certain or they are fixed, right? But at the same time, there are certain uncertain things, or I can say variable, right? They vary. They are not fixed. They are not certain. Now, if I may say, what all are components in a financial in a derivative that are fixed are underlying, right? So underlying is very clearly specified in the contract. It never changes, right? It remains same. For example, equity of X limited, right? For example, any other commodity that has to be very clearly specified. Second, quantity of underlying is also very much specified. So these things don't change in a derivative. These things remain same. Now, for example, one equity share, two equity share, 10 equity share, how much the underlying, what quantity of underlying are we talking about in the financial contract, right? Similarly, even quality of underlying, this will also be fixed. Now, if I talk about a crude oil, let's say grade A crude oil, it will be specified in the contract that we are talking about grade A crude oil and this much of the quantity and time period, that for what time period this derivative is valid for, right? So for this, for what time period this contract is valid for. Then what is not certain or what is uncertain is price of derivative, right? Because this really is dependent on the price of the underlying. Whichever direction the price of the underlying moves, in that relationship, the price of the derivative will also move. Clear? So these are some of the basic things on derivatives. Now let's focus our discussion on the first type of derivative, which is the forward contracts. Okay. So we are talking about types of derivatives. In that, the first one to start with is the forward contracts. Yeah. Now, to understand forward contract, let's build this case study against which we will be plotting the concept. So let's say there is a procurement manager of some company, right? There is a procurement manager of some company, and that procurement manager wants to purchase crude oil grade A 20 liters, right? I'm just taking an example, hypothetical example, but he wants delivery after 6 months from today. Okay, so the delivery is required after 6 months from today. So this is the catch, right? And today price is, let's say, 100 rupees per liter. And you are also given this indication that after 6 months, price is likely to go up. So these are the factual informations given to us. The delivery is required after 6 months. It is not needed today. Today the price is 100, and after 6 months the price is likely to go up. Now, what option procurement manager have? Procurement manager can go and talk to the supplier, right? And tell the supplier about the requirement. So let's say this is the procurement manager and this is the supplier, right? And talk to the supplier. The supplier will say that, okay, see, if I deliver you after 6 months, my pricing is likely to go up. So procurement manager says that, okay, let's lock the price today. Okay, let's fix the price today. So what procurement manager does is, let's say they lock 110 per liter. Okay, so supplier says that, okay, I'm okay to supply you after 6 months at 110 rupees per liter. And what will supplier do? Supplier will supply 20 liters of grade A crude oil. Now, if you see from a commercial angle, this is a very simple contract, right? It seems to be a contract of supply of raw material, or let's say supply of any sort of material, right? But what we have ended up doing here is, we have ended up doing here to create a forward contract. I'll take you through how we are talking about that. This is a forward contract by taking you through different situations that might happen, right? So this is the story as on today, right? Now what will happen after 6 months? This is the story as on today, that the price is locked at 110, and the supplier will supply the 20 liters of grade A crude oil. Now after 6 months, let's see, there can be different possibilities, right? One, the price can be higher, it can be lower, or it can remain same at 110. So we will talk about case procurement manager, the actual price appearing, then negotiated price, and the supplier, right? So these are all the parties concerned, right? Let's say in case one, we talk about, let's say, the actual price. Okay, negotiated price is 110, right? The actual price becomes 115. Now, can you tell me, after 6 months, let's say we are standing as on the date of delivery, whenever the delivery has to happen, I am a procurement manager. I have a contract in place to get supplies at 110, right? The actual price is 115 as on that date. So can you tell me from my angle, the procurement manager's angle, whether it's a benefit to me or it's a disadvantage to me?
Benefit to me.
Benefits, sir.
Yes, it's a benefit to me. Why? Because had I not have this contract in place, yes, very good. Very good to all those who have responded. Perfect. So had this contract not been in place, I would have ended up paying 115 to purchase the crude oil from the open market. Correct? Similarly, from a supplier perspective, supplier has a contract to supply at 110. The open market rate is 115. So supplier will say that I am at a loss of 5 rupees because of this contract, I am selling 5 rupees lower had I been able to sell in the market, right? So can I say that in the first case, there is a 5 rupees gain to the procurement manager and 5 rupees loss to the supplier? Clear? In the second case, 110 is still the negotiated price. Let's assume the actual price becomes 95. Now, if I understand from the procurement manager side, 110 is the contract to purchase the crude oil that I have, but the open market rate itself is 95. So, I am having a gain or a loss here as a
Loss.
procurement manager.
Loss.
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 Very good. Yes. Because had I not entered into this contract, I would have purchased the oil from the market at 95. And hence, because of this contract, I have a 15 rupees loss. Please understand my wording very clearly here. Because of this contract, there is a loss of 15 rupees. And in the above example, because of this contract, there was a gain of 5 rupees. Clear? Had this contract not been there, the question of this gain or loss have never been arrived. Yes, very good, Karthik. And Jini Oja. So there is a benefit to the seller of 15 rupees. Clear? Now, what I'm trying to discuss here is that because of this locking of the price at 110, which is one of the condition, or let's say which is one of the terms of the forward contract, right? What we have done, we have actually led our different pricing to come and to create different sort of payoffs for both procurement manager and supplier. In the last case, I'm just keeping this as same. So if in the actual open market, the price is also 110, I also have a contract at 110. So there is no gain, no loss, either for the procurement manager or for the supplier. Okay. So in a nutshell, whatever contract we have, right, which has to be settled on a later on date, which has some sort of an underlying, right, and the value is being derived from that underlying, that is really called as a derivative. Okay. Now let's also talk about the actual settlement, how it will happen. Since we are talking about forward contract, students, okay, so the settlement of this forward contracts after 6 months, how it will happen? The supplier will deliver the goods and the procurement manager will pay to the supplier. We are talking about after 6 months. Now, procurement manager pay 20 liters at the rate. Now, can anyone tell me at what rate procurement manager will pay to the supplier?
Fixed contracted rate at the rate of 110.
Very good. Yes, very good. It will happen at 110. So don't get confused here, because some of you might think that the procurement manager will pay at the actual rate that is appearing in the market. No, that's not the case, because there is a contract in place, and that contract is bound for both procurement manager and supplier both, right? So ultimately, the entire payment of this 2200 will happen from procurement manager to supplier side, and supplier will deliver 20 liters of grade A crude oil. Now it's a separate story that procurement manager will end up having a gain or a loss because of the actual price movements of the underlying in the market. That's a separate story. But as far as the settlement of this forward contract is concerned, it will happen at a forward contracted price. Hemant, we will come to the pricing. Okay, we will come how the pricing is calculated of the forward contract, right? We have those things in detail. Clear. So this being a forward contract, the settlement is happening at a gross level, students. Okay, the settlement is happening at a gross level. Now, if I may summarize about the forward contracts, so these are over the counter contracts. Now, over the counter means highly customized. So this term means that these are highly customized contracts. Now, if you see the above example that I've taken, it's a very customized contract for the procurement manager, because the procurement manager wants 20-liter crude oil grade A specifically, and that too after 6 months, right? So it's a very customized kind of a contract, hence over the counter, and this is customized to suit the requirement of the buyer or seller, right? And the second feature of this forward contract is this is always settled on a gross basis. This is called as the gross basis. By gross basis, I mean that entire amount will be paid to the seller, so to the supplier, and the supplier will deliver the goods. This is called as the gross basis. The above table that we have here, that we have prepared, these are called as the net basis, right? This is net basis settlement. I'll come to that. Okay, clear? So forward is clear. Now, linking to this discussion, yes, I think Abdekish, you have a question. You're raising the hand.
Yes, sir. Sir, is there any common platform where the forward contract can be deal into, like stock exchange, for example, shares or any securities? How to find buyer and
Yes.
seller? How we can find?
Yes. Okay, that's a good question. So what happens for forwards? Always in most of the contract, the counterparty is bank. Okay, let's say I am a supplier or I am a buyer of some product, and I want certain, let's say, forward for a foreign exchange, right? Because I'm exporting or importing. So to hedge against the risk of the foreign exchange, I enter into a forward contract with the bank. So again, since it is a highly customized contract, it is generally not traded on the stock exchange, right? Because yeah, because the the viability of this contract is only for the person who has entered, only for the buyer and seller, right? Because it is highly customized to them. So a third person on the stock exchange might not be interested to purchase. Sorry. Okay. So these are not traded on the stock exchange forwards. Okay. These are only entered into a contract between two parties, which both of them will execute at the end. Okay. Now, if I talk about futures, these are the second types of derivatives. Okay. Again, this is a financial instrument. Okay. Now, everything is same to the forwards except for the fact that these are standard contracts. So what I was saying is forwards are customized contracts, futures are standard contracts. By standard, I mean it will have a fixed quality, it will have a fixed quantity, right? Let's say there is a lot size of 1,000 shares or the underlying on which this derivative will trade. The lot size is 1,000, right? So this was the over the counter contract, and this is a standard contract which is having a very standard terms and conditions. The second thing is for futures, here the settlement on net basis, right? That means there is a net payoffs that are there. Okay. In this, there is no concept of gross basis of settlement, right? This one is not applicable here in futures. Okay, so no actual delivery. Now, if I talk about the net basis, in this example itself, assume this is a future, right? Then, had the case one happened, the procurement manager would have received 5 rupees and the supplier would have paid 5 rupees. In the second case, had the price been 95 and this being a future, then in that case, 15 rupees had been paid by the procurement manager and 15 rupees had been received by the supplier. Now you will say, what? How will they get benefited by having a net payoff? See, the idea is simple. Procurement manager in case one will receive 5 rupees from the supplier and 110 already their contracted price was there, right? So the procurement manager will add 5 rupees to the 110 that the procurement manager was supposed to pay, and from that 115 the procurement manager will go in the open market and purchase the actual delivery. Okay, but the actual delivery will not be given by the supplier. Clear? I'm talking about the net basis of settlement, students. Similarly, here 15 rupees procurement manager will pay to the supplier, and balance 95 rupees it will go, he or she will go in the open market and purchase the delivery, purchase the goods basically. Clear? So in totality 110 will become the outcome, outflow of the outflow of the cash from the procurement manager side in both the cases, I'm saying, right? So this is how futures are settled actually. Okay, because these are standard contracts, right? And the actual delivery of underlying never happens in a future. Then futures are traded on a recognized stock exchange. Are traded on stock exchange. So this happens. Now to answer your question, Abrikesh, this futures are the financial instruments which gets traded on the stock exchange.
Yes, okay.
Okay,
Sir, can you
because these are
repeat?
very much standard.
Sir,
Yeah, sorry.
sir, can you repeat when means I understood when the prices are high, the supplier will pay the extra amount so that he can directly go and buy in the market. When the prices are low, can you repeat that again, sir? What happens?
Yes, yes, sure, sure. So let me come back to this second case where the actual price is lower, right? So 15 rupees procurement manager will pay to the supplier, and balance 95 rupees the procurement manager will go in the open market and purchase. So in totality from procurement manager side, 110, which is 95 plus 15, is the final outflow of the cash, right? which is what originally procurement manager is supposed to do. Clear? Yeah. Then,
Yes, sir.
yeah. So, okay, clear. So this is the discussion that I wanted to do on the forwards and futures. Now, I hope as products, or let's say as derivatives, both the forwards and futures concept is clear to all of you. We will come to some of the formulas, how the value is derived, all those things on a later stage. But at least this part is clear as of now. Okay.
Sir,
Now, yes,
sir, can we
yes,
say in
Priya.
case of forward that party in gain will receive from party at loss?
Yes, that will happen. That is true. So party in gain will always receive the payoff from the party in loss,
Okay, sir.
right? Because one person's gain will become another person's loss for an equal amount. Okay. Now, let me also tell you why are we calling these as derivatives? Because some of you might be thinking that the price is fixed at 110. In this example, some of you might be thinking that the price is fixed. But what I'm saying is, this is not the price. This is a term and condition of the contract. The real pricing is this, right? The real pricing is this. And the moment the spot price, so let's say we are into the third month, then fourth month, then fifth month, then finally sixth month. So let's say we are into the third month. During that third month, the price of the forward will be different because it will again depend on what is the spot price happening on that some of the interest element, right? That we will be discussing how to calculate the forward price at back and then. Okay. Yes. Perfect. So now let's move ahead. So I will be discussing some of the cases with you. Yeah. There is some question. Okay. Now I will be
Sir,
discussing
sorry,
some
sir.
of the, yeah.
Sorry, sir, Prakash.
Yeah, British.
Some students'
Yeah,
mic
yeah.
is unmuted, sir. It's continuous, some disturbance is coming. Other than yours.
Okay. Understood. Can anyone check, please? Yes, I think now it should be okay. Yeah. So let me take you through with some of the cases, right, which are specifically designed to help you in the understanding and hence to solve some of the questions, right? Now, please pay your 100% attention. This is a very critical part. So I'm taking case one. Okay, I'm just trying to help you devise some of the strategy, how we can strategize to basically minimize our losses. Now, if let's say you know that the prices are going to go up in future, right? In the time to come, the prices are going to go up. That you are already aware of, right? Price are going up in time to come. Let's say using some analysis, using some historical, trend analysis, we understand that the prices are going to go up in future, and we are talking about equity share of X Limited. Okay, let's restrict our conversation to only the equity shares of X Limited. So this is the underlying. Okay, now one is that you will purchase the equity share in the spot market, but let's leave that aside because we are having discussion on derivatives. So let's understand from derivatives. I am asking one question and all of you can answer whether buying future is relevant for me in this case or selling future is relevant for me in this case. While I say buying future, okay, let me repeat. Buying future means I am I am from the procurement manager's side because I have to buy the underlying, right? I am actually buying or not, that's a separate thing. But the buyer and seller means the buyer here is procurement manager and seller here is the supplier. So this is the perspective that I'm giving. Whether you should buy or sell so that once the price goes up, you will gain. What
Buy,
strategy you will do?
buying future.
Buy. Very good.
Buy, sir.
Very good. Yes, buying. Perfect. So I think all of you are correct. Why we will buy the future? We will not sell future. The buying future concept is because let's say that today pricing of this future is 100 and we know that it will go up, right? The moment it will go up, let's say it becomes 120. So 20 rupees gain you will have, right? That's why you will buy. Now if I take case 2, you understand that price is expected to go down in time to come. Okay. Now I'll give you three options. One is you will buy future, or you will sell future, or you will do nothing. Which strategy will you pick and choose here?
Here's the future.
Yes, sir.
Very good. Very good. Very good. I think all of you are saying selling the future. These two things you will not do. But some of you might be thinking that for selling, buying is necessary, right? How can you sell something that you don't have? That's a clear dilemma, right? I can't sell any property which I don't purchase it first. But since we're talking about derivatives here, students, and as I said that in case of futures, derivatives needs no settlement. Even if you sell futures, you're not required to make any deliveries, correct? Because the settlement is happening on net basis. Hence, only in FNO segment, which is futures and options segment, you can do short selling. This is called as short selling, where you are selling something which you don't have. Okay. Now, let me clarify. There are these some technical terms. So, buying is called as long position, selling is called as short position. So, if you buy first and you are having that as an investment with you, you will end up having called as a long position. If you sell first without buying it, right? So still you have a position to close, right? Because ultimately you have to purchase later. So that is called as short position here. Now in this case, what you will do? In this case, let's say the price is 120 today and it is going to go down, right? Let's say it becomes 100. So you will sell today at 120, and then after let's say 2 months, the tenure of this forward is 2 months, for future is 2 months, for example. So after 2 months, you will purchase at 100, right? So what is your profit? 120 minus 100, right? Because you have purchased anything at 100, you have sold first at 120. So ultimately you will end up having a 20 rupees profit here, right? And you don't, so for selling this, you don't need to deliver the underlying because you're talking about futures here. Yes, Nisha, you're right. Take a short position today and buy when the price goes down. This is exactly what I'm trying to explain. Now, I hope this is clear, right? So, whenever the question will talk about that the person is having a long position, so try to understand that the person has already purchased the derivative. it's already in the buying position. If the question says that Mr. X is having a short position, that means understand that already Mr. A have sold or has already become the seller of that derivative, right? And the position will get closed once you purchase the derivative later on. Okay, then only the settlement will happen. Now, the short selling also has a twist to it. We were talking about FNO market, which is the futures and options, right? And second one was the cash market, right? Cash or spot market. So here you can do long position. Here you can also do long position. This is allowed, right? Both the places you can do long position. There is no issue in that. Can you do short selling here? Is this
No,
allowed?
no,
Yes. Yes, because it's not allowed. Why? Because the cash or spot market requires delivery. How can you deliver what you don't have, right? So you have to first purchase and then only sell, right? However, in case of intraday, okay, so there are two things, right? Interday and intraday. So intraday means that you are purchasing one day and selling another day, this one. But intraday, this one is intra day. Within the same day, you are purchasing and selling. So short selling is allowed in intraday because you can sell today morning and purchase today evening. That is allowed, right? Because the settlement will happen on a day basis. For the day, whatever contract you have entered, that will have settle on a single day. That's why it is okay. So interday not allowed, intraday allowed. For long, okay, now for short selling in FNO market, it's allowed. Whether it is interday or intraday, it is allowed. Okay. Now there are some questions. Karthik is saying, sir, when the prices get lower, we are ending up buying the instrument. So how can we say that the settlement is on net basis? It is just that delivery is delayed or something. No, Karthik. So ultimately, here we will close out our short position by taking a long position. But again, by purchasing, I'm not saying that I will actually get the delivery of equity shares of X Limited. I'm not saying that. Hence, the delivery is not happening either at the selling time or at the purchasing time. Only the net settlement or the net payout of this 20 rupees will be received by the person who has taken the short position. And this will be paid by the other person who has taken the long position. Yes, so Mamta is saying, please repeat the long and short concept. So I will just repeat the same concept, okay? So students, as we said that there are two kinds of things that you can do in the market. Either you can buy or you can sell, right? Only these two kind of things you can do in the market. Now, as a buyer, if you buy first and sell later, so buy till the time you are buying that instrument, that is called as a long position because you have bought it and kept it. The short position is that strategy where you sell first and later on you buy. Okay. Why? Because the key to make money is not only when the prices goes up. You can also make money when the prices goes down. When the prices goes down, you can just reverse your action or reverse your order of selling first and buying later. Clear? If this you all of you can skip this if this is not understood, it's irrelevant. But from a FNO market perspective, both long position and short position is allowed. Okay, I hope this is clear, students.
Yes, sir.
Perfect. Okay, now Abhikesh is asking, square off is mandatory on at settlement date time. See, squaring off you can do at any point of time in case of futures. right? Because futures are traded on a stock exchange. So let's say today I sell a future of X Limited. Now, and the maturity of that future is 2 months from today. Okay. Now, after 10 days, if I realize that, okay, this is the price at which I want to purchase it back. So I can settle it after 10 days also. I can settle out my position after 10 days by purchasing the same future in the market. Okay. So it can happen anytime up to the date of maturity in case of futures. In case of forwards, it will depend on the terms and conditions that are mentioned in the contract. Now, as I said that forward is a customized contract, right? Now, even this part you can mention in the contract whether the settlement will happen at any point of time up to the tenured date or only on the settlement date. That also can be specified in the contract. Okay, and practically also I have seen the forward contracts that the bank enters for, let's say, selling or purchasing of the foreign exchange, let's say in case of export or import, they also give you timing up to that maturity date. At any time up to maturity date, you can sell or purchase the foreign exchange. Okay, so it will be specified in the contract for forwards. Okay, now if I talk about cash segment, I mean the cash or the spot market. If I talk about forwards here, and if I talk about futures here, right? So forwards are over the counter customized contracts, right? Actual basis delivery happens, 100% gross basis settlement will happen. Clear? Cash segment becomes the underlying, right, for forwards or futures, right? So cash market, the prices are an outcome of what? The regular buying or selling activity, right? And it becomes the basis for the forwards or futures. Now, these futures are actually standard contracts. These are traded on stock exchange, and hence there is a net payoff that is calculated here. I hope this is clear, students. Perfect. Now, let's come to the pricing part. Now we will discuss about the pricing. Okay. So I hope till now our basic block building has happened, right, in our minds, that how basically the derivatives works, what is the basic meaning of futures and forwards, right? How their settlement happens, what is the difference between future and forward, right? Now let's come to the pricing. Now, as we said that the prices of the futures or forwards also keeps on changing, right? Because whatever is mentioned in the contract as the logged price, that 110 rupees, remember in the case study, it's only a term and condition of the contract. It's not the price of contract. Again, I'm saying it's not the price of that forward. It's only a part of the term and condition. Using that, we calculate the price, right? Now, to understand the pricing, let us first brush up our concepts on compounding. Simple interest, compound interest, right? I'm just writing some of the formulas. A is equal to P 1 plus R raised to the power T, where A is equal to the future value, right? We used to call, right, future value, present value, using the compounding method, right? P used to be the present value. R is equal to the rate of return. and T is equal to time period, right? Clear? So using this formula, we can arrive from the present value to future value, right? For, let's say, semi-annual compounding. What do we mean by semi-annual compounding? That means the
Half
compounding
yearly.
is happening after, sorry?
Half yearly transaction.
Yes, half yearly. Yes, yes. So it's happening every half yearly, right? So the formula will change to what? A is equal to P 1 plus R divided by 2 raised to the power 2 into
2 into
T.
T.
Yeah, perfect. So what we are saying is this R is actually per annum rate, right? Hence we have done divided by 2 to arrive at the 6 monthly rate. And T is equal to 1 year. So 1 year split into 2, that's why we are doing 2 into T. So using this, there is a generic formula that I can derive, which is A is equal to P 1 plus R divided by N raised to the power T into N, where A is equal to the future value, P is equal to the present value, R is equal to the rate of return percentage on a per annum basis. Okay. T is equal to time period, and 1 year is equal to 1 for T. Let's say there are 2 years, so T will become 2. If there are 3 years, T will become 3. And N is equal to number of compounding in a year. Okay. So N is actually how many times the compounding is happening in a year. Clear, students? So let's put these numbers and understand it better. So let's say time is 3 years, rate of interest is 10%, and compounding is happening quarterly. Okay, if the compounding is happening quarterly, what will the formula look like? A is equal to P 1 plus 10% divided by 4 raised to the power 3 years, which is T into 4. So this 4 will become N. How I've derived 4? Compounding quarterly means 4 times in a year the compounding will happen, right? So N becomes 4, T becomes 3, and R is 10%. Clear, students?
Yes, sir.
This is very, very important. Again, I'm saying because this will be useful uh, in the formulas. Yeah. So, just a second. I'm just checking for any of the questions on the query handle also. Yeah, there are none. Now there is a concept of continuous compounding, students. Okay. Now, What do we mean by continuous compounding? Continuous compounding means that the compounding is happening every moment, every second, every millisecond, the compounding is happening. That means it is happening. So n becomes infinite. So the n, which is number of times a compounding is happening in a year, it becomes infinite. The moment it happens, so there is a very simple formula. Okay, it looks very uh, difficult to understand, but very easy to see. A is equal to P e raised to the power R t. Okay, where e is actually the exponential function, raised to the power R is basically the rate of interest, and t is again the time period. And here A is equal to the future value, P becomes the present value, R is equal to the percentage per annum, T is equal to again time year, assuming 1 year is equal to 1. And E is actually exponential function, right? So these values are given in some of the tables, or it will be specifically given to you in the question. Okay. Right. Now we have revised the concepts on compounding, right? We are talking about the pricing, and before entering into the pricing, we just wanted to understand that how compounding works, right? So compounding is happening in two ways. So this is called as discrete compounding. Okay, if I may tell you, this is called as discrete compounding. Discrete means it has breaks in between, right? Let's say after every 3 months, after every 6 months, the compounding is happening on a discrete basis, and this is called as continuous compounding. This formula is called for continuous compounding. Clear? Now, let's come to the valuation of forward slash futures. Okay. Now, the valuation of forwards or futures, because it is same, one and the same thing, the way we calculate, hence we can understand both of them at the same level. So the present value, which is the spot price appearing as on today, right? If we calculate its future value, then we arrive at the, so this is called as the price of a forward. Okay. So whatever is the price appearing as on today, and let's say the future or forward is going to expire after 2 months, the tenure is 2 months remaining. So the future value of today's price after 2 months is called as the value of the forward or future, or let's say the price of the forward or future. So the price of a forward slash future is equal to future value of spot price. And how are we going to calculate the future value? Using the discrete compounding or continuous compounding, the way question asks us to do, right? We will be given the spot price, we will be given the rate of interest, whether we have to apply the continuous compounding or discrete compounding. Using that, we can calculate the future value, which will become the price of the forward or future, right? And here the expiry will become the time period, correct? For calculating the future date. Oh, sorry, future value. Right? So again, I'm just mentioning here, there are two ways to calculate discrete compounding. A is equal to P 1 plus R divided by N raised to the power Tn. Second is continuous compounding. A is equal to P e raised to the power RT, right? So let's say today is, let's say, 4th November 24. We are standing at a spot price of 100. Okay. Now for this 2-month future, 3-month future, let's say there are three different types of futures being traded in the market. Yes, Hemant, I am just trying to explain it. So 1 month, 2 month, and 3 month, right? Let's say there are three different types of futures being traded on the spot price of rupees 100. Let's say again, X limited equity share is the underlying we are talking about. Clear? So what will happen? The 1 month expiry is the forward of 1 month expiry will calculate the future value using the 1 month as time period here, right? T will become 1 month, and here also T will become 1 month. So let's say this is 101. Let's say 1 rupees is the interest for 1 month. For 2 months, it will add up for 2 months. For 3 months, it will add up for 3 months. Okay. Again, it will add basis the compounding, whatever we use, but the value will be higher. Higher the tenure, higher will be the future value, correct? Because the compounding will increase. Lower the months, lower the expiry, lower the future value will become. Right? So can I say that rupees 101 is the future value of rupees 100 after 1 month, right? I hope this statement helps you to understand it better. The future value of rupees 100 for how many months? For the expiry period that is there in that contract. I'm saying that, say, 1 month. The future value for 100 rupees after 1 month will become the future price. Okay. Clear? Now let's also understand the treatment of dividend and transaction cost. Now there are two things if we talk about that impacts the pricing. One is dividend. We are talking about the equity as underlying, right? There will be dividend and there will be transaction cost. Now again, dividend can also be denoted in two ways. One is the continuous dividend, which we call as dividend yield, right? Now, if you understand from a share market perspective, and even I think in some of the earlier topics, you would have studied that what is the dividend yield. Dividend yield is, let's say, 5% per annum. That means on an average basis, 5% dividend gets accrued to the stock and it gets paid by the company. That is called as dividend yield. That is on a continuous basis, right? Or on a discrete basis. Again, it can happen either ways. So one, I'm talking about the discrete dividend. First of all, the question will specify whether it is a discrete dividend or continuous dividend, but the formula will be different. Okay. So A is equal to P minus present value of dividend into 1 plus R divided by N raised to the power Tn. So this will become the revised formula. Why I have reduced present value of dividend from here? Because the dividend is already included in the price or the spot price, right? Whenever we pay dividend, it's already included in the spot price, because the moment you end up paying dividend, your spot price falls to that amount, whatever amount you have paid as dividend. But we are talking about futures. On futures, there is no dividend, right? So from the spot price, we are reducing dividend to create the X dividend price, and using that pricing, we calculate the price of the futures. Now let's talk about the transaction cost. So P minus present value of dividend, till here we understood. Now in case the question says that there is a transaction cost as well, now the transaction cost gets added, right? So we will add the present value of transaction cost. So this becomes the revised spot price. And this will be multiplied by 1 plus R divided by N raised to the power Tn. Okay. And the third formula, in case of discrete dividend, but the continuous compounding of the interest, right, the R, it will become A is equal to same thing, P minus present value of dividend plus present value of transaction cost multiplied by e raised to the power RT. Here the rate of interest is actually on the continuous basis. And finally, the second case we are taking for continuous dividend. See, this was the discrete dividend, these three formulas. Then the continuous dividend, there is only one formula which is very easy. A is equal to P e raised to the power R minus Y into T. So here Y is equal to the dividend yield. This formula is very, very important. Most oftenly used is this formula, where even the dividend is on a continuous basis, and even the rate of interest is also on a constant basis. So transaction price is part of the price, because transaction price, so let's say if you are going to purchase in the spot market, right, you will end up spending this much of transaction cost to purchase that underlying, and hence it will impact your future or forward value. Okay, so the transaction part is included in the price and the dividend is excluded, because dividend is not paid on futures, it's only paid on the actual underlying. Clear? We will do some of the questions to understand these things in detail. Now the last thing in this discussion that we are covering, then we will step into the another discussion. On expiry, can anyone tell me what will the price of future become? For a principal, on a principal basis, what will really be the price of future on expiry. Let's say today is the expiry of that future, and today the price of future will be equal to what? Can anyone attempt?
Original price.
Sorry,
Original price. Sorry.
original price. Yes, very good. Or let's say the spot price.
Or price.
No, not
Technical word is.
contract price. Yeah, yeah. So Nisha is saying contract price. No, again, contract price is one of the term and condition of the contract, right? The forward, the 110 rupees in our example. But the price of the future is something else. Price of the future is dependent on the ongoing spot price, right? Now, what will happen on expiry? On expiry, the time period will become zero, right? And e raised to the power 0 will become 1, and 1 will get multiplied with p. So a will become equal to p on a mathematical basis. On a conceptual basis, the time to expire will become 0. That means there is no interest element that will get added on the principal, and hence the price of the future will become equal to the price of the spot on expiry. This will become equal. So if I just wanted to show it through graph, so here is our expiry being plotted on this side, right? And here is actually difference in future price versus spot price, right? Finally, let's say here the expiry is due at this stage, right? The initially difference will be higher. It will be becoming zero on the expiry date. The difference between future price and spot price. Let's say future price and spot price, as on the initiation, it is 102, it is 100. So there is a 2 rupees gap. Then it will eventually become sorry, okay, let me just put it, then it will become, let's say 110 becomes the spot price after 1 month, and 111 becomes the future price, right? Here the difference was how much? 2. Here the difference becomes 1 because 1 month has expired, right? This is 1 month has expired, hypothetically I'm saying. Then finally on expiry, let's say it becomes 105, the spot price, the future price will also become 105. So the difference here is 0. That's what we are saying here. The difference will become 0 on expiry. Clear? So this understanding is really important. Now after this, we will cover one more discussion point on hedging and speculation. Then we will come to questions. Okay. So let's take a break of 10 minutes, students. It's 8:25. Let's again reconvene at 8:35. we left our discussion on the pricing or valuation of the futures or forwards. Now let's also try to understand some of the uses of the derivatives, right? How are we actually going to use the derivatives in our day-to-day activities, right? So there are two things. There are two things. First thing is speculation. Speculation have two components. One is hope of gain or risk of loss. So by speculate we mean that we have a indication that the prices might go up or the prices might go down. Using that sentiment, we can either gain or lose, right? But this is a one-ended position. If the prices is going to go up, if the speculation is that the prices is going to go up, we will enter into a long position of derivatives, right? If the prices on the contrary goes down and we are having a long position, we will end up having a loss also. So there is a risk of loss, right? And if the prices we thought it will go up, it actually goes up, we will have a gain. That's why it is called as, from both the angles, it is called as hope of gain and risk of loss. Now, if we talk about our long position here, right, on let's say futures of X Limited, and here we are talking about the short position on futures of X Limited again. Okay. So we are trying to draw two parallels. One is on the long position of X Limited and second one is in the short position. And let's say it has happened on 80 rupees as the price for 1000 quantity, which is 80,000. Okay. This is the contract value. This is the contract value. Up, I will have a loss. Minus 10,000, right? Basis the lot size, plus 16,000. On a net basis, 6,000 I will get back. Now, if the prices has gone down in case of short sell, tell me whether we will have gain or loss because of the contract.
Gain.
Gain.
Very good. Very good. We will have gain. And the reason is the market is having the pricing as 70. I have entered into a contract to sell. Now, the contract to sell is at 80. So it is helping me to realize 10 rupees more over and above what is appearing in the market. So ultimately, because of the contract, I am having a gain of 10 rupees, right? So here I will have 10,000 plus 16,000 also plus, in totality 26,000 I will get back. Okay. So this is one of the use of speculation, right? If I have a speculation, there are two ways, either loss or gain. I think Abhishek, you have a question.
Yes, sir. In case of a gain, both the cases, long or short, from whose
Hmm.
pocket this money is coming? I mean, amount of gain. In both the case, 10,000 say. Suppose
Yes.
everybody has entered into contract and everybody has a gain, then who will bear this burden?
No, 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 no. Okay, I'll tell you. So this is the beauty. I think that's a very good question, first of all. So what is happening here? In case of a future or forward, as I said that always there are two parties, right? One there is a buyer and another one there is a seller. Now if the buyer is having a gain, the seller will have a loss of the equal amount, right? So in case the gain of 10 rupees in both the cases is coming to the buyer or seller respectively, the corresponding loss is being borne by the other party. Okay. So yeah, let's move to the second use of the derivative, which is hedging. Now, the difference between speculation and hedging is hedging, you fix your cash flows or you fix your earning potential or even the loss you fix. So that amount becomes fixed. It's not open ended like speculation. Speculation, in my example, if had this 70, I have taken as 50, the loss would have been 20,000 more, right? But hedging is actually protection against risk. Okay, and the amount of gain or loss is already fixed under this hedging part. So the entity is already exposed to a risk hedging against that risk by using future slash forwards. Now, if I ask you, okay, let me put it here, the risk and corresponding hedging strategy. So let's say the risk is holding on to the equity share in the spot market, holding equity share in spot market. Now, what is the risk here? If I'm a holding, so first of all, I request all of you to answer this. If I'm holding certain equity shares in the spot market as underlying, what is the risk I am exposed to? Can anyone tell me?
Price down. Price
For
is
Very
going
holding
good.
down.
equity shares.
Very good, very good. So the risk is that if tomorrow the price goes down, I will end up having a loss. So that is the risk for me. Market prices, yes, but going up or down. In case the market prices goes up, Hemant, then it's not a risk for me. It's a gain for me, right? So the risk is basically the prices will go down. So risk that the price will go down. Now to combat this risk, what hedging strategy should I do? Should I sell
Short.
futures or buy futures? Come on, tell me.
Sell
Sell
future. Short
future.
position.
Okay, why sell futures? Let me ask you.
Because we have, entered into, we have at a price, particular price, and price go down. If
Right,
the price go down and we have entered into the sale futures, so we
right,
can get the amount of the future price,
correct.
which we did it in
Or
advance. So it will be
yes. So, or the way we can say is if the risk of the price is going down, the way you will make money in futures is by short selling the futures, right? Because the moment you short sell and the price goes down, you gain, correct? And what will happen? The loss will become here and you will gain because of the selling futures. Hence, your strategy becomes complete. Clear? The moment price goes down, let's say I'm saying here, after some time the price goes down. Okay. Now what will happen? You have a loss here, but correspondingly you will have a gain here. Correct? By selling futures, prices goes down tomorrow, you gain. Clear? Now, in this what is happening ultimately? We are having limited loss slash gain, and that is also fixed. In this entire strategy, that also becomes fixed. That I will explain how. Okay, that I will explain how. But the underlying principle is that it becomes fixed. Let's try to understand through one of the example. Yes. So let's say that there are 100 shares purchased at 300 rupees per share. So this is one of the example. $300 per share. So what is the risk here? Since we are already holding the shares, the risk is of the risk price is going down. Risk of price going down. Yeah. So to combat this risk, what we are going to do to hedge against this risk, we are going to do the short selling of futures. Yeah, I hope I'm audible and visible.
Yes, sir.
Yeah, perfect.
Yes, sir.
So what I was saying is to protect against this risk of prices going down, what I will do is I will do a short selling of the futures. I will take a short position at the rate 350 per share, right? This is called as hedging. Now, please note, students, the price is different, right? Because this is the spot price and this is the future price, right? So, definitely, future price is having an element of interest added onto that. So, 300 to 350, there is an interest element. Now, let's take three different cases: closing price. So let's say it is 300, 350, and 400. I've taken three different examples. Okay. Now, initially, what has happened? Initially, first of all, for purchasing the shares, you would have end up paying 300 rupees, right? Which is 30,000 here, 30,000 here, and 30,000 here. In all the three cases, you would have ended up paying 30,000 rupees to purchase the shares. Then you would have also given margin for short selling 350 into 100 into, let's assume 20% is the margin. So on 35,000 into 20%, you will end up paying 7,000 rupees as margin, right? Clear? So this is the position taken initially. Now let's come to the expiry, or let's say settlement. Now on settlement, what will happen? First of all, you will realize the sale proceeds of the 100 shares that you have. This is the separate underlying that you are having, right? So this is happening through sales proceeds. 100 shares were there. In the first case, we have 300 rupees as the price. This one, right? So this is happening at 30,000 bucks. Here, 100 shares at 350. So you will end up realizing 35,000 here. And lastly, 100 at the rate 400. So you will end up realizing 40,000 in the last case. So this is the sale proceeds of the underlying that we are able to realize. Plus you will get your margin back, right? 7,000, 7,000 and 7,000. And then finally there will be plus minus gain slash loss on futures. So Ginny Oja is asking, sir, for margin, why have we taken 350 only? Because margin is always calculated on the price at which you have entered into the future. So the futures you have entered at 350, right? The short selling has happened at 350. So you will take margin on the same value, right? Now for the gain or loss, come on students, tell me. In the first case on futures, you will end up having a gain or loss.
Gain, sir.
Gain of 50 rupees.
50 rupees.
Very good. Yes. So there is a gain of 50 rupees. Why? Because 350 is the price at which we have already short sold earlier. 300 is the price as on today, right? So the prices has gone down. In case of a short position, if the prices goes down, you end up having a gain, right? On 100 units. So in totality, 5,000 rupees will become your gain. In the second case, what will happen? Is there a gain or there is a loss?
No gain, no loss, sir.
No
No,
gain, no
sir.
loss. Very good. So it will be nil here. And in the last case, where the
Gain.
prices has gone up,
Loss.
Loss of 50, sir.
yes, there will be a loss of 50. Very good. So why loss? Because 350 is the price at which you have sold. 400 is the price that you have purchased. So your purchased value is higher, right? So there is a loss of 5,000 rupees here. Okay, now let's do the maths quickly. So 30,000 plus 7,000 plus 5,000. This becomes 42,000. In the second case, 35,000 plus 7,000. This plus this. This becomes how much? 42,000. And the last case, 40 plus 7 minus 5. So 47 minus 5 is how much? 42,000. 47 minus 5 is 42,000. Now, how much you have invested initially? 37,000 in all the cases, right? This is what you have invested initially. So against this 37,000, in all the three cases, you are end up having 42,000. That means you are end up having 5,000, 5,000 and 5,000. So can you see, this is what hedging means. I told you, right? In hedging, you are having a limited loss or gain, and that becomes fixed on the day when you enter into those positions. So ultimately, you are having only 5,000 rupees in all the cases. So whatever the price will be, you will your earning potential is maximum up to 5,000 rupees per 100 shares. And can anyone tell me, had we not taken this below example from above only, from these two facts itself, the two stars that I have made, from these two facts itself, one can derive that what is the final outcome. One can derive that what is the final outcome. How? We have
350.
taken a, Yes,
The
yes,
future
go ahead,
price
go
that
ahead.
we have contracted less the actual purchase price of the shares into the contracted quantity price.
Very good, yes. So conceptually, if you see, we already have a short position in the futures market to sell at 350. So whatever the price will be, it will adjust for gain or loss, and our ultimate cash flow will become at the rate of 350. So the selling price ultimately will become 350. This is coming from futures, and the purchases will happen at the rate of spot price. This is happening at 300. So net 50 will become the gain per share into 100 shares becomes the 5000 fixed cash flow which we have referred above. And if one asks how we can prove this, then all the three cases are in front of you: case 1, case 2, and case 3. Whatever prices we take, we will end up having only 5,000 in all the cases. Okay, students, clear?
Yes, sir.
Perfect. So, if I talk about derivatives, and in that I'm talking about long position, and here I'm talking about short position. Okay, I'm just summarizing this, then we will move to the questions of the assignments. Okay, contract to buy on expiry, right? Sell on expiry. Clear? The future price is there in the derivative, right? For calculating the price of the future, we calculate it using the future price. Now, long position is actually exposed to the risk of downside or upside, students.
Downside.
Downside.
Yes, yes, exposed to the risk of downside, and here you are exposed to the risk of upside, because in case of short position, if the prices goes up, you lose. In case of short position, if prices goes down, you gain, right? So in case of short position, you are exposed to the risk of price being going upside. The moment it happens, then you are at a loss. So hence what happens, that in one market we take one position, and in the second market we take opposite position. Okay, so let's say in spot market we take buying position, then always in the derivative market we will take the short position.
Short position.
Yeah, now let's come to question number 1. Okay, should we start? Till now we have done all the understanding concepts, formulas, everything is being done. Now let's try some of the questions and apply all our understanding in the questions, right? So first of all, starting with question number 1, suppose that there is a future contract on a share presently trading at rupees 1000. The life of the future contract is 90 days, and during this time, the company will pay dividends of 7.5 in 30 days, 8.5 in 60 days, and 9 in 90 days. So if we have to put it, today is this. So this is 30 days, 60 days, and finally 90 days. So within 30 days, 7.5 rupees dividend will be paid. Then in 60 days, another 8.5 rupees will be paid as dividend, and another 9 rupees will be paid in 90 days as dividend. Okay. These are the three dividends that are given. Assuming that the compounded continuously risk-free rate of interest is 12%, the question is specified. It is continuously compounded. You are required to find out the fair value of the contract if no arbitrage opportunity exists. See, they're asking us to calculate the fair value of the contract. Fair value of the contract means the value at which the futures will be traded, right? So that means they're asking us to calculate the future value for 90 days expiry. Simple. Arbitrage, some of you knows what is arbitrage. What is arbitrage?
Taking opposite positions to nullify your loss or gain.
No loss,
Sorry,
no
Nisha.
profit.
Taking opposite positions to nullify your loss or gain.
Yes. So, so what I will say is arbitrage is riskless profit. So in arbitrage, what you do, you take opposite positions in different markets, and your gain is again fixed. So it's kind of a hedging only. Yes, because of the different prices in different markets, you end up devising one strategy, and using that strategy, you will always get some riskless profit. Okay, that profit is bound to happen to you. That is called as arbitrage. So it is saying that fair value, no arbitrage opportunity exists. This is an additional information given to us. Now let's start. We have to calculate the future 90 days value, and the present value is how much? 1000 rupees, right? The current spot price is 1000. That's what it is given to us. Now, first of all, since there is a different types of dividends, these are discrete dividends, can we first calculate the present value of dividends? So the present value of dividends is calculated how? 7.5 into e raised to the power. So future value we say e raised to the power RT. For the present value, it is divided by, right? So what it will become? It will become 1 by
Raised to
e.
minus.
Yes, raised to minus. That's what I was trying to explain. It becomes 1 divided by e, and hence in the power itself we do e raised to the power minus 0.12 is the rate of interest, and for 30 days becomes the time period. Okay, so this is for the first one. Plus second dividend is how much? 8.5 e raised to the power, again minus 0.12 into 60 days. Then the last one is for 9 rupees. This is for 90 days, right? So e raised to the power minus 0.12 into 90 divided by 360. So what we have done here, we have used A is equal to P e raised to the power RT, or present value. In this case, we have to calculate the present value, which is this value, right? So A P is equal to A into e raised to the power minus RT. The moment you do, you end up calculating the present value. So this is the present value, this is the future value, right? So P is the present value. So if you arrive at the present value from future value, you take it as e raised to the power minus RT. Okay. So this will become how much? The first part 7.5 into e raised to the power 0.12 into 30 by 360 if we do raised to the power e raised to the power minus 0.01 plus 8.5 into e raised to the power minus 0.02. Yes, plus 9 e raised to the power minus 0.03. Okay. Now, if you see the question, it also gives you these values. What is e raised to the power minus 0.01, minus 0.02, and minus 0.03? So we can just apply that. So 7.5 into e raised to the power minus 0.01 is 0.9905. This one. Plus 8.5 into 0.9802 plus 9 into 0.97045. These are the values that are given in the question itself. So the present value of dividend becomes how much? 7.43, 8.33, 8.73, right? In totality, it becomes 24.49. This is the present value of dividend. So Sumit is asking e raised to the power RT is called as dirty power. I don't know. It's only called as the exponential thing, is what I understand. Yes, Pooja, you have raised the hand.
No, sir. I have not
Okay,
raised the hand. I am just confirming with the
confirming.
calculation.
Okay, perfect. Clear, students, till now? So the present value of dividend we have calculated. Now let's calculate the fair value of futures contract. So 1000 is the
Spot price.
spot price, yes. So the 1000 is the spot price. Just a second. It should be yeah. 1000 is the spot price, and this is for 90 days, right? Just a second. Yeah. So 1000 into e raised to the power 0.12 into 90 by 360. I think there is one issue. There are two ways to look at it. I'm just writing it. Okay. So 1000 into e raised to the power 0.12 into 90 by 360 minus the dividend present value. Why I have done this, I will tell you. Okay. Is this part clear to all of you, or is there some query in this? So we have calculated the future value of 1000, and from that we have reduced the dividend. This is the value that is given in the question, right? Because if you solve this, this becomes e raised to the power 0.03, which is this one. So 1.03045 is the factor which will get multiplied minus 24.49. So the fair value of futures contract is equal to 1005.96. Clear, students?
Yes, sir.
See, now some of you might be thinking that in the formula, okay, where I also got stuck is what I'm trying to explain. So we also read this, right? E raised to the power RT, right? This can also be one of the way to calculate the solution, right? But why have we not resorted to this and rather taken this is because the question is saying that presently it is trading and in future the dividend is will be paid, right? So what we are trying to assume is that this 1000 is not already having the dividend value, right? Hence we are having the future value first and then arriving at the final value. Clear? So both the assumptions are correct. I am saying in case you want to solve using this is also equally okay. Clear, students? The second part of the question. Yes, Karthik.
Sir, why we have not to consider the future value of the dividends then, rather than present value? The future
Yeah,
value at the
that's
end
a
of third year.
yes. That's a valid question. Even I was also thinking on the similar lines. In case we have to reduce it, the future value has to be reduced, right? But again, as I said that, see, ideally the right way would have been this in the solution, okay, into e raised to the power RT, correct? I hope you agree with me, Karthik, till now.
Yes, sir.
Yes, so ideally this would have been the right way, but if I see the solution, right, because this is a question I've taken, I think, from some of the past attempt questions or maybe some of the question bank, right, from the institute itself. So the alternate solution that is given there is this as well. Okay. See, there are three school of thoughts, Karthik. Okay. One is that this one is totally fine, which we are okay with. The second school of thought is that you take the future value of 1000 rupees and even you take the future value of this dividend. Okay. Even you take the future value of this dividend. So everything is after 3 months and hence you arrive at the value. So that is also okay. The third, this why this solution is also okay is because the dividend is adjusted as on today. See, the way market will think from this future perspective is that that dividend will never become payable, right? So if you are adjusting it as on today also, that will still be okay from the future price. Okay. Then the next part is to calculate the value of cost to carry. Now, what is the meaning of cost to carry? So cost to carry is the difference between the future value and the present value. Okay. This is the difference between future value and present value. So the future value is, can we say that the spot price plus cost to carry. This is another way of looking the above equation, right? Spot price means the present value and plus cost to carry is equal to the future value, right? So here the cost to carry is how much? Minus 1000 is equal to 5.96. Okay. Okay, I hope this is clear. So again, I am repeating, ideally this should have been the adoption of the solution. This is the best way, 1000 minus 24.49. Then it should have been e raised to the power RT, right? But even this part is okay, the way this has been calculated in the solution. Let's move to the next question. Question number 2. Okay, so this is an earlier ICAI appeared question. Okay, examination appeared question. A company is long on 10 MT of copper. MT means metric ton. Okay, at the rate 534 per kg, which is the spot price, and intends to remain so for the ensuing quarter. So what they're saying is that the company is already having a long position. That means the company has already purchased the copper and kept it with us, kept it with them. The variance of change in its spot and future prices are 16% and 36% respectively, having correlation coefficient of 0.75. Now don't get distracted or don't get panicked here. These all things you would have studied in your portfolio management, right? What is the meaning of variance? What is the correlation coefficient, right? So what they are saying is the spot price is changing at 16%. The future price is changing, or let's say the volatility is at 36%. That's the variance. And between both of them, 0.75 is what how they are correlated. The contract size of one contract is 1000 kgs. Required, calculate the optimal hedge ratio for a perfect hedging in a future market. Now, students, let me introduce one more concept here. So, till now, what we have been understanding is that one underlying will be will be hedged, or let's say one underlying is equal to the one future value contract. But in reality, it's not the case, right? So let's say one future contract can help you to hedge against, let's say, even five of the underlyings. In terms of count, I'm telling you, one contract can help you to hedge against the five equity shares, or let's say one can help you to hedge against two also, or one can help you to hedge against zero point 0.5 equity share as well, right? So it is called as the hedge ratio. Hedge ratio is how much quantity of futures you have to purchase or sell in order to hedge against the any given quantity of the underlying. Okay, it's not always one-to-one relationship, students. Okay, so first of all, it is asking us to calculate the optimal hedge ratio. So by optimal hedge ratio, we mean that it has to be a perfect hedging. What is the hedge ratio using which we will have a perfect hedging? Advise the position to be taken in future market for perfect hedging. In case in the spot market we have a long position, in future market what position should we take is the question. Then third one, determine the number and the amount of copper futures to achieve a perfect hedge. This is the third part of the question. See, these are very good questions, right? So let's first try to understand the optimal hedge ratio. So the formula of optimal hedge ratio is given by R, which is correlation coefficient multiplied by standard deviation of spot price divided by standard deviation of future price. R is equal to correlation coefficient between change in spot price and future price. Now, students, do you recognize this formula to something that you have understood in the portfolio management? Is this formula very similar to something? Can anyone tell me what is that in the portfolio management?
Beta.
Very good.
Sharp
This is
ratio.
very similar. Yeah. Yeah, go ahead. I think someone was speaking.
It's a sharp ratio.
Yeah, even, yes, you're right. It was a sharp ratio, but in that, I think this R is not there. This correlation coefficient is not there. But yes, it is very similar to beta. Because the way beta is also calculated, you do correlation coefficient between the market as well as the stock, and then take the standard deviation of stock and the standard deviation of market, right? So this correlation coefficient, the same principle applies here. Whatever is the optimal hedge ratio is calculated using this, right? So standard deviation of S is standard deviation of spot price standard deviation of S is actually the standard deviation of future price. So first of all, we have been given variance of spot price. We have to convert it into standard deviation because variance and standard deviation are two different things. So the square root of variance becomes the standard deviation. This is actually 4%, right? And variance of future price is actually 36%. If I'm not wrong, yes.
Yes.
And the standard deviation of future price becomes square root of 36%, which is actually 6%. So the optimal hedge ratio becomes 0.75, which is the correlation coefficient, into 0.04 divided by 0.06, which is actually 0.50. So for every one share, or let's say for every 1 metric ton of copper, 0.5 derivatives can be entered into to achieve a perfect hedge. This is the real meaning. Okay, so the optimal hedge ratio means that what quantity will be what quantities position will be taken in the derivatives market to achieve at a perfect or a complete hedge in the spot market. Now, the first one is done. Second one, advise the position to be taken in the future market for perfect hedging. That all of you can answer now, right? If I'm having a long position in the spot market, what position I have to take in the futures market?
Short position.
Short.
Very good. We have to take the short position. So this is the first part. The position to be taken in futures market would be short position, as in the spot market long position is taken. Clear? Now the last one, determine the number and the amount of copper futures to achieve a perfect hedge. Now for that we need only one thing, which is the optimal hedge ratio, which we have already calculated. Since the contract size, we have been given that the contract size is 1000 kgs, right? 1000 kg, which is given here, right? The contract size is of the 1000 kg. This is for the derivatives that they're talking about, right? Since the contract size is 1000 kgs, number of contracts to be short sold is how much?
Five. Five.
Yes, very good. The answer is 5. But let's derive that 5. So 10 metric ton of copper is already having a long position. So 10 metric ton means 10,000 kgs is the total long position that we have. In that, first of all, we will multiply our optimal hedge ratio, right? Because for 10,000 kgs, we only need to hedge for 5,000 kgs, right? And since we have to calculate the number of contracts, so one contract is having 1000 kgs. So in a way, 5 contracts to be short sold. So number of contracts is 5. And the question is asking two things, right? One is the number of contracts, second is the amount of contract. Determine the number and the amount, right? It is asking for both. So the amount of the contract will become how much? Five contracts at the rate 1000 kg into what is the price? I think the question is not had given us the future price,
Yes.
right?
524 is a spot price. So we
Spot
don't have.
price. We don't have, yeah. So we don't have that option, but the question is asking us to calculate the amount. So we will take 534 itself here. For reference, we will take the same amount, 26,70,000.
So, if the future price is given in the question, then we have to
Then
take
you
that
will take
now.
that. Then you will take that, yes. The future price is given in the question, then you will take that. Okay? I hope the question is understood and clear.
Yes, sir.
So let me twist this. Let's say the hedge ratio would have been 2. In that case, what would have been the answer here? Tell me. In case the optimal hedge ratio would have come as 2 instead of 0.5. Rest all things remain same. Then
20,
how many?
20 contracts.
20
Yes.
contracts and the cost is 10680.
Yes, very good. Very good, very good. So it would have been in 20 contracts, right? So the application is easy, right? Whatever is the hedge ratio, we just need to apply it to the spot number of quantity that we have to arrive at the number of forwards or futures that we have to enter into. Very less likely that the hedge ratio is 1 is to 1. Practically also the hedge ratio is other than 1 is to 1. Okay, so let's come to question number 3, students. I hope till now the understanding is clear around the questions as well as the concepts. Please do let me know in case something needs to be re-explained or rediscussed. Okay, so let's move ahead. I'm just simultaneously checking the other query handle also. There are no queries over there. Yeah. Question number 3. Mr. Careless was employed with ABC Portfolio Consultants. The work profile of Mr. Careless involves advising the clients about taking positions in the future market to obtain hedge in the position that they are holding. So that means they are holding some position in the spot market, and against that, Mr. Careless has to advise them about the positions that they have to take in the futures market. Clear? Mr. Triple Z, their regular client, purchased 1 lakh shares of X Inc. at a price of $22. So this is the one of the position in the spot market, right? Purchase of the 1 lakh shares, and sold 50,000 shares of APLC for $40 each, having beta 2. Okay, so the APLC is having a beta of 2. Mr. Careless advised Mr. Triple Z to take short position in the index future, trading at 1,000 for each contract, $1,000 for each contract. Now there are 3 positions, students. This is a very good question I'm telling you. So there are 3 positions, students, now, right? One is the long position in spot market of X Inc. Second one is the short position of APLC. Third one is the short position in index futures. This is in the futures market. Though Mr. Careless noted the name of APLC along with its beta value during discussion with Mr. Triple Z, but forgot to record the beta value of X Inc. Forget to record the beta value of X Inc. On the next day, Mr. Triple Z closed out his position when share price of X Inc. dropped by 2%. Share price of APLC appreciated by 3%. So, does this mean a loss or a gain for Mr. Triple Z? Come on, students, tell me. The share
Loss.
price of X Inc. is
Loss.
dropped. Loss,
Both
yes.
case loss.
This one is also a loss. Now, third one, index futures dropped by 1.5%. He has taken the short position in index futures. Whether it is a loss or a gain.
Gain.
Gain, sir.
Very good. It's a gain. Okay. Mr. Triple Z informed Mr. Careless that he has made a loss of $1,14,500 due to the positions taken. So for all the 3 positions taken together, there is a cumulative loss of this much. Since record of Mr. Careless was incomplete, he approached you to help him find out the number of contract of future contract. He advised Mr. Triple Z to be short to obtain a complete hedge and beta of X Inc. So there are 2 missing informations that Mr. Careless is asking from us. One is the beta of X Inc. And the second one is the number of contracts that he would have advised to Triple Z to take a short position in index futures. You are required to find these values. Now, First of all, what is the relevance of beta here? Let me tell you. There are two ways you can do a hedge, right? One way is you can do a hedging using same share futures, right? Let's say X limited share is there and X limited future is there, right? Here the hedge ratio comes into picture, which will tell you against how many shares, how many futures needs to be purchased or sold. Even the X limited share can also be hedged using the market index futures. Here beta value is used, where X limited is hedged using the market index. So index is what? Index is, let's say, BSE, NSE, Sensex or Nifty, right? I'm just giving an example. So beta is what? Beta represents the movement of X limited prices in relation to the market, right? Similarly, if index future is there, index future is deriving its value from the index, right? Here the underlying is what? Index. So the spot price is having a correlation with this index, and this index future is having a correlation against this index again. So ultimately, can we say that X limited is correlated to index futures through beta? The answer is yes. Okay, so that is where the beta will be used. Now let's come to the solution. Let's first see what are the different types of position that triple Z is holding. One is X Inc. 1 lakh shares into $22. There is a long position, right? But the prices has gone down by 2%. APLC, there is a short position of 50,000 into $40. There is a short position and the prices have gone up by 3%. The index, which is $1,000 into number of contracts we don't know, and here also we had a short position. The prices has gone down by 1.5%. That's what we know. And the overall loss or gain on this is dollars 114,500. This is what is given in the question. This clearly summarizes. So let's come to the solution. Let's assume one to be X and another to be Y, so that we can substitute in the equations and it becomes easier to do the solution. Let number of contract in index futures be Y. Sorry. Okay. And beta of X Inc. be X. So how this person would have arrived at the number of contracts? 1 lakh into 22 is the price multiplied by the beta, right? This is the long position minus, from that the person would have reduced the short position, right? Into 50,000 into 40 into 2. So 50,000 contracts, 2 is the beta and 40 was the price at the time of short selling the number of shares. The contract size is 1,000, right? And that would have become the minus Y. Why minus? Because we will be short selling this futures, right? That's what the indication from question is also there, that the index futures are short sold. So hence this negative sign is actually taken to indicate the short position. So in a way, can I say that the position amount, whether long or short, which is let's say the quantity multiplied by rate multiplied by beta, will be used for index futures, right? So beta has to be multiplied. Can we rewrite this as 22 lakh x minus, how much will this become? 50 into 40 into 2. This becomes 40 lakhs minus 1000 y. Okay, now if I say, so this is one equation. Now if I say that the cash outflow, which is the opening position on day 0, right? On the day once the contract were being entered, purchase of 1 lakh into 22 is what we have done, right? So we would have ended up spending 22 lakhs here. See, here I'm not multiplying by beta, right? Because here I'm just calculating the actual cash outflow and inflow, right? So sale of 50,000 shares at the rate 40. So this is 20 lakhs. On a net basis, we receive 2 lakhs. Short position in index futures, 1000 y minus, right? This is what we will do. Clear? Why I'm taking minuses? Because it's a short position. Again, on 1000 is the contract size and y are the number of contracts. So opening outlay becomes 2 lakh minus 1000 y. Clear? So this is cash outflow on the opening day. Then on next day, following positions would be calculated. So what you will do, since you already have a long position in the 1 lakh shares, so you will be selling those 1 lakh shares at the rate 22 into what is the increase, what is the decrease? 2% is the decrease, right? So ultimately 1 lakh into 22 into 0.98, right? Because 2% there is a decrease. So there will be a plus of 21 lakh 56,000, right? This will become your inflow. The moment you will close out your position of selling the same, the purchase of 50,000 shares at the rate 40, where the price has increased by 3%, right? So it will become into 1.03. Here you will end up paying 20 lakh 60,000. Clear? And You will take now long position in index futures, which is how much? 1000y multiplied by 98.50 percentage. This is the third element that we will do, right? Because the index has gone down by 1.5%. So it will become minus 985y. So this will become 96,000 minus 985y. Clear? So now the position on closeout will be how much? The opening amount minus the closing amount. This will be equal to the loss that has been incurred, right? This is the opening and this is the closing position. So if we solve for this only has y in this, right? So if we solve for this, the y becomes minus 700. So the number of contracts that were short sold is 700 contracts, and the beta of X Inc. can be calculated as 22 lakh X minus 40 lakhs is equal to minus 1000 into 700, right? So this becomes X is equal to 1.5. Hence, beta of X Inc. is 1.5. Clear, students? So using this piece of information, we can calculate both the things.
Sir, short sold means sold short by 700 contracts, or is a short type
No.
of
Short
contract?
selling. No. Short sold means selling, short selling basically. The total number of contracts 700 are short sold. That means they have been sold first and purchased later basically.
Okay.
It's a short selling. Okay. So
Yes, sir.
yeah. So let us quickly revise what we have studied today, right? So, students, we started our discussion on derivatives, and first of all, we try to understand that derivatives is totally different from the underlying. It is not that derivative and underlying is the same thing. It's not like that. Underlying can be commodity, equity, foreign exchange, any kind of index or weather, right? And it can be other things also. And derivative is a contract that derives its value from the underlying. Then we also understood about some of the common and basic features of the derivatives, which is all across the instruments. One, there is a buyer and seller, which is different from the regular buyer and seller of the underlying, right? Then we also said that the value of derivative is dependent on the value of the underlying. That now I think this is pretty clear, right? Because the value of the underlying is in lot of questions we discussed, right? For example, in the previous one also, the index was the underlying, right? So the index future will derive its value from the index. Similarly, the shares will derive its value from the share, and the formulas also we have discussed in case of discrete compounding, in case of continuous compounding. Similarly, in case of discrete dividend, continuous dividend, how the formulas will look like. So the pricing, the value is clear from a future and forward perspective. Then we also said that it has to have a fixed tenure, because if it expires in, let's say, 1 month, 2 month, 3 month, or any time, calculation will happen. Since there is a fixed tenure, there is a settlement that is also required to happen. Then there are different types of derivatives that we started our discussion with. The first one was on the forward contracts. Forward contracts, we discussed through this case study and said that forward contracts are highly customized. These are over the counter contracts. These are settled on a gross basis, right? In case of futures, we said that these are very much standard contracts, right? So the quality and quantity is very much defined. The settlement happens on a net basis, and these futures are traded on a recognized stock exchange. So these are the two differences between futures and forwards. The way we calculate the pricing is very much similar. And we also understood that what are the different techniques that we have to devise in case the price is going to go up or price is going to go down. Similarly, on the pricing part, we discussed about the compounding, semi-annual compounding, and using that we derived a universal formula for compounding in case of a discrete one. In case of continuous compounding, we made use of e raised to the power RT, which is having a continuous compounding methodology, which is most widely used and very, very important. Then we introduced the concept of valuation. In that, we introduced the concept of dividend and transaction cost. So the dividend is always reduced from the spot price, right, to arrive at the future value, and the transaction cost is added to the spot price to arrive at the future price. And we said that whatever is the difference between future and spot price, that becomes zero towards the expiry of the contract, because on expiry the future price becomes the spot price because there is no interest element left. Then we discussed about two different things. One is on the speculation, which is a one-sided gain or loss. Here you are not covering up for any other position that you have taken in any other market. But hedging, on the other hand, is one position is taken in one market and second position you are trying to take in the another market, right? And then these are some of the questions that we did. Yeah, any other question from the today's discussion, or else we will close out today's session. Yes, Abrikesh, you have a question.
Yes, sir. Sir, is there any chances that transaction cost is also continuous, or it is, I mean, just a single amount? There are no chances of increase in
See,
transaction cost is a continuous has been given.
so see, in case it is continuous, mathematically we know how to treat it, right? It's just a future value and present value using the same formula. But I would say
Okay.
that transaction cost, I mean, would vary. It would be very little chances that it might be in a continuous form, right? Because it is on a transaction to transaction basis, basically.
Yes,
So
sir. Still, I mean, just to twist the exam question, sometimes suppose they ask,
yeah,
that's why I'm
yeah,
asking.
yeah. So in case it is asked in the question, then very much you are equipped to apply the formula in the similar manner and answer it accordingly, basically.
Okay. Thank you,
ठीक
sir.
है ना? Because we have already discussed, right? In case of a continuous way, we always
Yes,
use
yes.
e raised to the power RT, right? Wherein
Yes, yes.
either present
Yes,
value
sir.
or future value, whatever we have to do, we can do that using the same thing. Okay?
Okay, sir. Thank you. Yeah.
Yeah. So I request now C. Ashish sir to
Uh,
help with
Thank
the
you.
concluding remarks.
Thank
Yes.
you,
Thank
Devas
you.
sir. Your lecture
Thank you,
was
sir.
very informative, and you have very beautifully explained the difference between forward and the future. Okay, and I think there was one query from Abrikesh sir, from where we can get entered into the forward contract. Generally, of course, your answer was right, because in case of foreign exchange, it is normally maximum cases, it is a banker. Okay, but however, we can say that even a forward contract are a valid contract even if two-person mutually agreed. Like there are some, I just it will this will topic will be later discussed. There's a term like ISDA. Okay, International Swap Dealers Association. Basically, swap agreement that we will discuss later on part of derivative. They are generally also the OTC based contract, and in that case, yes, just so in that case, what happens? If these are, though they are the OTC contract based because they are mutually agreed with the bank, but they are some regulated by some guidelines. So generally, forward contracts are also sometimes guided by, you can regulate it by some guidelines. Next very important point, when we have discussed the topic of derivative, but we never encourage the students to indulge yourself into derivative speculation, because our main purpose is to just to make you aware about the concept of derivative. Of course, derivative can be used for the speculative as well as for hedging purpose, but here in our class, the main purpose shall be to the how we can use the derivative for hedging. This is the main purpose. So we have to mainly concentrate our focus only on the academic purpose, because if we go because sometimes the student may feel that if we start indulging in derivative trading, then we will also have a good idea of the concept. No, that is a wrong. The practically may little bit be different also. And especially in the recently newspaper, there is a news that all the maximum of the young people are losing their money because of future and option trading. So my request to you, please don't indulge yourself in any way in any derivative trading, etc. Now, one thing I would like, because I hear, well, write only one line. Derivative is a zero sum game. Zero sum game. What it means? The loss of one will be the profit of other. So we have to keep in this mind, there is no productivity out of derivative transactions. So we have to be very conscious. That's why there's a point. Another very important point, I think, Divas sir, you may have covered it, or if it has been skipped, I would like to cover counterparty risk. Have you covered, Divas sir, the same?
No, sir. No, sir. This is
Okay.
not covered.
So see, students, I would like to here mention that forward and future contract, if you are seeing, there is a one important difference. Of course, there are some features like that. Forward contracts are customized, future contracts are standardized, they are traded on a stock exchange. Of course, these are right. But there is one very important element that distinguish a forward contract from the future contract, and that is the counterparty risk. Okay, of course, in case if you are the counterparty is a bank, normally there are the chances of the defaults are very least. But sometime if you are entering into a where two general parties are there, not non-banking companies are, non-banking firms are, or non-banking entities are there, generally there is a chances of counterparty risk. And that risk is eliminated in case of future contract. Now question arises, because there is an exchange mechanism involved. There is a party A, party B. Okay. Now here, if forward contract is there, there is a direct dealing between them. Okay. But if we go by the uh, uh, future contract, then of course the party A will contact exchange, and it will exchange the contact the party B, and whatever be the delivery will be made, it will be made to delivery this and this that way. Okay. So of course, future contracts are cash settle based. Normally they are not delivery based, and they are mostly cash. But very important ki these are, there is no counterparty risk because of E, that is exchange mechanism. Now question arises, how the exchange mechanism, how the exchange itself protects against the counterparty risk of any party. Okay, counterparty. So what they do, they involve what the Divas sir has discussed with you, the margin requirement. This is the basis of hedging the counterparty risk even by the exchange. So with this, student, we come to the end of this today's topic. That same topic will be discontinued in the next class. And Divas sir, thanks a lot for
Thank
sparing
you.
your precious time and enlightening the student
Thank
on
you.
any topic. If you want to supplement my discussion, you are welcome. Otherwise, you
No, no,
can
sir.
continue the same next class. Okay,
Yeah.
student.
No, no, sir.
Thanks a lot
Thank
for
you.
your patient listening and see you in the next class. Have a nice day.
Thank you. Thank
Thank
you.
you, sir.
Thank you.
Thank you,
Thank
Divas,
you,
sir.
sir.
Thank
Thank
you.
you,
Thank
Manoj ji.
you.
Thank you. Thank you.